How often have you looked at your bank account and wondered, where did all my money go? Or maybe you've thought about investing, but felt overwhelmed by all the jargon and complexity. Well, you're not alone. Making smart investment decisions can feel like trying to solve a complex puzzle. But don't worry, I've got you covered. This is Prosperity Pulse Point, and I'm going to break down the investment process into simple, actionable steps. We're going to cut through the fluff and focus on what really matters: making good investment decisions. And by the end of this video, you'll not only have a solid foundation for investing, but also a bonus investment tip to help you get started. So grab a pen and paper or open up that note-taking app because you don't want to miss out on this. Chapter 1. Tip 1. Start with a goal. Let's talk about the foundation of any successful investment strategy: setting clear goals. It's like planning a road trip. Without a destination, you're just driving in circles. So, what's your financial endgame? Are you saving for a down payment, planning for retirement, or looking to build wealth for future generations? Having a clear picture of where you want to be financially will guide your investment decisions. Understanding your business net worth is crucial. Think of it as your financial snapshot. It's the sum total of your assets minus your liabilities. Knowing this number helps you assess your starting point and determine how much you can realistically invest. Another key factor is your risk tolerance. Are you the type of person who can stomach market fluctuations, or do you prefer a steadier approach? Understanding your comfort level with risk will help you choose investments that align with your personality. Now, it's time to create your investment roadmap. This is your personalized plan for reaching your financial goals. Break down your long-term objectives into smaller, achievable steps. For example, if you want to retire in 20 years, you might set goals like saving a certain amount each year or diversifying your portfolio. Remember, your investment goals can evolve over time. Life changes, and so should your financial plan. This doesn't mean that you change them every other day because you decided to go bonkers on a new TV for your room, but when something significant happens. Let's say you wanted to buy an apartment in the next 5 years, but along the way, you fell in love, got married, and now you have a baby coming along. Now that apartment, is it still a good option to raise a family? Or should you consider something else? That's why it's essential to revisit and adjust your goals regularly. Chapter 2. Tip 2. Manage your cash flow. Okay, we've talked about setting goals, but let's talk about the fuel that powers your investment engine: cash flow. Cash flow is simply the money coming in versus the money going out. Imagine your cash flow as a river. You want a steady, strong flow to feed your investments. If the river runs dry, so does your ability to invest. So, how do you ensure a healthy cash flow? It starts with tracking your income and expenses. Know where your money is coming from and where it's going. There are plenty of budgeting apps and tools out there to help you with this. Once you know where your money is going, look for areas to cut back. Maybe you can reduce unnecessary subscriptions or find cheaper alternatives for utilities. Every dollar you save is a potential investment dollar. Building an emergency fund is also crucial. Life is unpredictable, and unexpected expenses can derail your investment plans. Having a safety net will protect your investments from market fluctuations and personal setbacks. Chapter 3. Tip 3. Diversify your portfolio. Imagine putting all your eggs in one basket. If that basket drops, you lose everything. That's why diversification is key in investing. Diversification means spreading your investments across different asset classes. Think of it like building a sturdy house. You don't want all your weight on one pillar. Common asset classes include stocks, bonds, real estate, and even commodities like gold. Each asset class behaves differently in various economic conditions. By owning a mix, you can reduce your risk of significant losses. Let's say the stock market takes a dive. If you have a diversified portfolio, your bonds or real estate investments might offset those losses. It's like having insurance for your money. But diversification isn't just about throwing money at different things. It's about creating a balanced portfolio that aligns with your risk tolerance and financial goals. A financial advisor can help you build a diversified portfolio tailored to your specific needs. Chapter 4. Tip 4. Calculate prospective ROI. Now, let's talk about the sexy or fun side of investing. Return on investment, or ROI. It's essentially a measure of how much you've earned on your investment relative to the amount you invested. Understanding ROI is crucial for making informed investment decisions. It helps you gauge the profitability of different investment options and compare them apples to apples. Calculating ROI might sound complex, but it's actually quite simple. You subtract your initial investment from your final value, divide the result by the initial investment, and multiply by 100 to get a percentage. For instance, if you invested $1,000 and it grew to $1,200, your ROI would be 20%. While a high ROI is tempting, it's essential to consider other factors. High-risk investments often come with the potential for higher returns, but they also carry a greater chance of loss. It's important to balance potential returns with your risk tolerance. Diversification plays a role here too. While a single investment might offer a high ROI, a diversified portfolio can provide more consistent returns over the long term. By spreading your investments across different asset classes, you can reduce your overall risk. Let's say you're considering investing in stocks versus real estate. By collecting the potential ROI for each, you can make a more informed decision. However, don't solely rely on ROI. Consider factors like liquidity, time horizon, and your overall financial goals. Remember, past performance is not indicative of future results. An investment with a high historical ROI doesn't guarantee similar returns in the future. It's essential to conduct thorough research and consider various factors before making investment decisions. Chapter 5. Review and adjust regularly. Investing isn't a set-it-and-forget-it game. It requires ongoing attention. Think of your investments as a garden. You wouldn't plant seeds and then walk away, expecting a beautiful flower bed to magically appear. Regularly review your investment portfolio. How are your investments performing? Are they aligned with your financial goals? Are there any red flags you need to address? Economic conditions, market trends, and your personal circumstances can change. That's why it's essential to stay informed. Keep an eye on financial news, but be wary of hype and fear-mongering. If your investments aren't performing as expected or your financial goals have changed, it might be time to make adjustments. This could mean selling underperforming investments, rebalancing your portfolio, or exploring new opportunities. Remember, investing is a marathon, not a sprint. Stay patient, stay disciplined, and keep your eyes on the long-term goal. With careful planning, diversification, and regular monitoring, you can increase your chances of achieving financial success. Chapter 6. Financial Advisors. We've covered a lot of ground today, from setting goals to diversifying your portfolio. But let's face it, investing can be complex and time-consuming. Not everyone is a financial whiz. That's where financial advisors come in. A financial advisor is a professional who provides guidance on managing your money and investments. They can help you develop a personalized financial plan, create a diversified portfolio, and make informed investment decisions. Think of a financial advisor as your personal financial coach. They can offer expert advice, help you navigate complex financial markets, and provide peace of mind. However, it's important to choose a qualified advisor who has your best interests at heart. While DIY investing can be rewarding, it's not for everyone. If you lack the time, knowledge, or desire to manage your investments on your own, a financial advisor can be a valuable asset. Remember, seeking professional advice doesn't mean you're giving up control. It's about partnering with an expert to help you reach your financial goals. So, there you have it. 5 key tips to make better investment decisions, plus a bonus tip on seeking professional advice. Remember, investing is a journey, not a sprint. Stay informed, stay disciplined, and don't be afraid to seek help when needed. With the right approach and mindset, you can build a strong financial future. And that's it for today. Thanks for watching this video. And don't forget to like and subscribe to my channel for more finance-related content.